I didn't do one yet. Good morning. This is the House Appropriations Committee. It's Friday, March 13th, 2026. It's 9:05 a.m. and we're going to hear a couple of bills. And I do just want to acknowledge that 6 years ago today was Friday, March 13th, and it was our last day in the House because of COVID 2020. And we all knew that we had that week to put together bills and pass things out that we thought would help Vermonters because we thought we might be gone for a couple of weeks. Back. That's when telehealth happened and a few other things about notaries and I mean, all kinds of things. Every committee was asked to say, what can we do remotely? How can we work things while we are gone for a few weeks? And then we didn't come back until 2022. Remote the next year, and some of you got elected that year. at least a couple
day.
Except for that one day, yes,
That
that's
one day.
a whole other story. Anyway, I just want to acknowledge because many of us were here on that Friday, March 13th. And it was 6 years ago today.
I think that was an emergency meeting.
Okay,
Yes, I just want
we're
to,
here for this afternoon. You have time.
I just want
All right, I
to,
guess that was our joke. What?
that was the Thursday, yesterday.
Yes.
It was the day we rewrote the entire UI bill.
Yeah.
And
Oh, the unemployment insurance bill. Yes,
did it so that way everybody could go on unemployment and not.
that's right.
Any kind of money.
Right.
All the employers would not be penalized for 3 years.
Right.
And we did that Thursday and Friday. And when we came up for air and went out to the floor,
Yeah.
every bill was being pushed through like,
It was the fastest, we have never done so much legislation.
nobody even knew what these bills were. They just.
I know.
It was, yeah, well, I don't think most of them got acted on, but the point of it is they all ended up going,
Yeah.
these are, crossover
Yeah.
day. And everything was, notwithstanding blah, 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 where, blah, 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 they were all sent to the Senate.
Yeah, yeah.
And then we didn't come back till June, May, something.
No, oh, yes, it was June, and then our poor RT department had to help House members figure out their computers.
And we had.
Which a lot of them didn't know, I mean, and then do Zoom, which of course half of them had never heard of, and then they sent us all those little things to cover up our cameras, they mailed them to us.
Yeah, and that was one of the capacity, so
Yeah.
certain committees could go on Zoom at certain times.
Right, because we didn't have the capacity at the time. Anyway, we're taking a trip down memory lane, and it was quite a time.
Commerce was one of the ones that did it because we had to figure out how to use that care money.
Yeah, it was
Help the
It
rest.
was something that we will never forget, but I just wanted to acknowledge because this is the same day, Friday, March 13th. So happy Friday the 13th. Now we'll go to age 775. Cameron, you were in a different role then. A very different role. The other end of that bill. And then we had legislators get trained to help you all out. Okay.
How many unemployed in a month?
Yeah, we went from, at the time, less than 5,000 to over 100,000 in a matter of 2 weeks.
Right. Those are the days, and we're all still here in whatever capacity. Okay. So Cameron, we'll have you tell us about 775. Ted is here to talk about the fiscal note. Oh, sorry, Cameron and John. We must have two different parts. We have Rep. Tom Charlton here from the Committee on General and Housing to talk about it as well. So we'll start with you guys.
Yes, ma'am. For the record, Cameron Wood, Office of Legislative Counsel.
John Gray, Ledge Counsel.
So we'll walk through the recommendation, the report from the General and Housing Committee. And I asked John to join me this morning because the first section of the bill is within his portfolio area and it would be best to speak to it. So I'll share my screen. We'll walk through the General and Housing report, and then we'll switch over and I can run through the amendment that's proposed from the Ways and Means Committee. I'm going to share my screen and I'll let John kick it off.
I'm fortunate in that I have the first section of this bill, which is great for me because I should probably.
Yes.
Okay, so special assessment bonds. Just a little bit of background. I think you guys are familiar with special assessments in the first place. They're like a tax, but they're levied on individual properties that benefit from a particular public improvement that benefits their area, right? So special assessments, there's existing statute that deals with special assessments, those districts. This does nothing to modify those. This is a section that creates a new financing tool predicated on those special assessments. And it's just a new form of revenue bond. So what you're seeing here is it's trying to confront a practical problem that occurs in this space, which is that for a general obligation bond, you need the consent of the voters of a whole majority of a municipality, right, to issue general obligation bonds. But because special assessments are just assessments against the subject properties, issuing a general obligation bond in that context doesn't make as much sense. So this proposes to set up a new financing tool. It's section 1, this is 24 VSA section 3257. And the key thing here is this first clause of section A, upon approval of the legislative body of the municipality, and subject to subsection C, a municipality may issue revenue bonds for the purpose of financing a public improvement for the benefit of the limited area of the municipality to be served by the improvement. So this is saying you can approve, a municipality may issue these kinds of bonds without the vote of the municipality. It can be done upon the approval of the legislative body. And I'll come to why some concerns you may have are not necessarily present in this case. And then we have the standard call out. Revenue bond issued under the section is issued for an essential and governmental purpose, including for tax purposes. So the typical reason folks get antsy about issuing a bond in the absence of a majority vote, right, is you're concerned that the taxpayers are on the hook. Someone could compel a tax levy and they're forced to cover those costs. And so it's key that this is just a revenue bond. It is a bond not backed by the faith and credit, right, of that municipality. It's backed by just the revenues, just the assessments from the district. So that's what you see in B. A revenue bond issued pursuant to this section shall be payable solely and exclusively from the special assessments levied on the properties to be served by the improvement and shall not constitute general indebtedness of the municipality. And then the key additional call out, no holder of a bond issued under the section shall have the right to compel any exercise of the taxing power of the municipality to pay on the bond. So what does that mean? They only have recourse to the revenues that come in. That's it. So this doesn't add anything. It doesn't change anything about the way special assessment works. It just says you could use this financing tool to back up a bond with those revenues. If we jump to subsection C, this is kind of a less core part of it. This is more about the marketability, but this is language that had been included at the bond bank's suggestion to protect the markets. And it's a condition for issuance of these revenue bonds. The muni may issue a revenue bond pursuant to the section only if one of these conditions is met. That you receive a commitment letter for the issuance, so backed by one of these reputable institutions, the Vermont Bond Bank, a bank regulated by the FDIC, Office of the Comptroller, the Federal Reserve, or a credit union regulated by the National Credit Union Administration. So if you get a commitment letter from one of these reputable institutions, that would be a condition that you would meet this requirement for issuance of the revenue bond. Alternatively, you didn't get a commitment letter, you could get a minimum credit rating to satisfy the requirements of the section. And that's what we see in subdivision 2 on line 11. If you got a nationally recognized statistical rating organization that has an active U.S. public finance practice, rates the issuance at a minimum credit rating of BBB or equivalent, which is essentially, that is an investment grade bond.
Yeah, it's very good, but it's not AAA or anything else.
Doesn't have to be.
Is that sort of standard, the BBB for these kinds of things?
So the reason that this was selected is that this keeps you out of non-investment grade or junk bond territory. So it's kind of
It's the
still
low.
within the, and technically it's higher than the lowest. The lowest would be BBB minus, I guess, right? So it's not the absolute lowest, but it's keeping you in investment grade territory is basically the.
Was there a worry that, and let me know if you're not the right person, but is there a worry that if we went higher, fewer towns or municipalities would qualify?
I think that's a fair assumption, is that you want to keep this tool available to folks. And again, this isn't a core part of the ability to authorize it. I mean, it is essential to the section itself. I just mean to say that this is included, I think, mainly as a protection for the markets themselves, is the way that I think of it, to ensure that that the municipal markets aren't flooded with bad bonds, essentially.
Right.
So
please clarify for me again, not again, please clarify for me. Revenue bonds are riskier than full faith credit. They are,
No. So in this instance, a bondholder doesn't have recourse to the taxing capacity of the municipality. Typically, if there's a shortfall, right, a bondholder could say, you got to pay us. And then the municipality is obligated to do a tax levy to raise the funds to cover it. There is no authority for the municipality to compel a tax levy in this case. And I think maybe this is the answer to your question. So it is safer for the municipality. It is riskier for the investors. I think maybe what you were.
yes, I mean, that's exactly right. So, and can you just give me an example of how this works? Because this has colors of TIF districts or TIF fine, the idea that you can raise money in a different way than out and out tax. Can you explain to me, the town of Waterbury wants to build affordable housing in a place, how this would work?
So I have an unhappy answer and a happy answer. The unhappy answer is I don't know that I can give you what you want, but the happy answer I have is that I think the question you're asking is actually about special assessments themselves and not about.
What's the revenue?
The special assessments. So there is an existing process, and this section does nothing to disrupt the way that special assessments currently work. An assessment is a tax levied against properties receiving the benefit of a particular public improvement. So in this case, you're talking about pursuing housing, for instance. Under that chapter, a special assessment can be levied only if the town itself votes by majority or all of the subject properties themselves consent in writing to that. So that process would continue to exist. This approval by a legislative body for just the revenue bond doesn't disrupt anything or change the standards for pursuit of those public improvements that are backed by the special assessments themselves. And as I understand it, you're not typically funding the entirety of these projects through a special assessment. It's just part of a capital stack that you're using.
Right, but I mean, this was, anyway, the specifics of it are still, I mean, and then talk a little bit about the difference between needing to get a public vote on it. Is that in relation to the taxing perspective, or, I mean, this seems a little, I take kind of a deep sigh when I think that a municipal board can commit to this without a public vote. That's just, sure, I just haven't experienced it. And I'm not saying it's wrong. I just haven't experienced what that means for the town and for that select.
Exactly. So part of why both hackles get raised in a context like that is that for a typical general obligation bond, the issue is that if you just have the legislative board approve, later the bondholders could actually afford residents of the town to then cover any shortfall in the revenues. So that's why we require majority votes in those instances, right? Is that it's actually going to be the residents of the municipality that are on the hook for it. In this case, because the only thing backing it are the revenues themselves, the only recourse that the bondholders would have is to those revenues. So whether they come in or don't, it's just part of an agreement that already has to be set up through this separate process. That's the only thing the bondholders can go to. They cannot compel a tax levy to force the residents of the municipality to pay on it. So it raises different concerns. It's not the same. The residents are not at the same risk as they are for a general obligation bond, which is why I described it as less risky to the municipality, but more risky to the investors. And I'm sure other folks could speak to this as well.
Thank you.
Can we?
So this is for low cost housing, obviously. And so as part of this analysis, did they actually look at what those revenues would be, whether the revenues would be sufficient to?
So this is not exclusively, this is special assessments can use for all sorts of purposes. This is truly just adding a new financing tool. Whether it will or won't be used, I have no idea. I mean, it's creating a new authority so that municipalities could more simply access long-term financing on the basis of an already existing revenue raising tool that they have, which is special assessment. So it's truly just saying you can do revenue bonds, you can do special assessments. why not do revenue bonds backed by special assessments?
I used to in banking do revenue bonds a lot.
There's no downside, again, nothing can go back on the municipality.
So legally municipalities on the hook, but the only recourse that the bondholders have is to the revenues. They can't compel a tax levy.
So I do share Tom's concerns, because recently, I know our town purchased a house without going to the voters, and that's causing a little.
I think the
That's
best,
a different thing.
yeah, and I think the best thing to speak to this, because I understand with so much material come through here, it's important to separate out the bond from the special assessment process itself. All of the procedures that are in place for special assessments have to be followed. So you're not even going to have these revenues to have a special assessment bond unless you have pursued the process of imposing the special assessments, which requires either majority vote of the town or that all of the subject properties receiving the public improvement that are subject to that special assessment have consented in writing. So all of that continues to stand. This is truly just a new financing tool.
Okay, and I know I'm getting a text that you're being called to Ways and Means, but so why don't we finish whatever your parts are?
That is the whole of my part.
That's the whole of your part. Well, that was good timing.
done.
Thank you so much for
Yes.
coming, John. And if we have other questions, and we can check in with John this
Sounds good.
time offline.
Perfect.
Great.
Thank you, guys.
Thank you. All right, let me,
I'm going to take over here. We're going to move into section 2. This is going to be on the second half of page 2 here. The next two sections really go hand in hand with each other. The section 2, the first piece here is regarding the Vermont State Treasurer and the Vermont State Treasurer's ability to create a credit facility and invest currently up to 10% of the state's average cash on hand. What I will say here is on section 2 here at the bottom of page 2, this new language that's underlined is simply reorganizing the section so it will kind of fit better with the amendments that are further down. So what this requires is any of these investments that the state treasurer is making, they need to comply with the Uniform Prudent Investors Act. That's already a requirement in the statute, as you can see here on page 3, lines 5 and 6. I've simply moved them up so it applies to the amendment that I'm later on in this section. So currently, the state treasurer has the authority to create this credit facility of up to 10%. So they take 10% of the state's average cash balance and they can invest those monies. There's really no limitation on what the state can invest the money in. So it could be in economic development initiatives. I think recently over the past few years, they've been investing a lot of that in housing. But there's no statutory limit on where those monies are into kind of what sectors they have to be invested in. So this proposal would be to raise the credit facility to 12.5%, up from 10 to 12.5. And then separate from that, what you have here in the B and then the 2 is separate from the 12.5, the state treasurer can create a separate facility of up to 1% of the state's average cash balance. And we're going to limit that 1% to look at lines 12 and 13. The 1% can only be used to facilitate housing development through bulk purchasing of offsite constructed housing to aid in the purchase of offsite constructed housing units. And then the other key piece here to notice is at the end of that subdivision B, any portion of this 1% authority, any amount that the treasurer's office chooses to use here has to reduce in equal amount the credit facility established under the 12.5%. The reason this language is here is because you're increasing up to 12.5% from 10. You're authorizing this additional 1%, but the treasurer's office didn't want that to go to 13.5%. They wanted to keep the total at 12.5.
so the up to 1% is part of the 12.5?
Yes, ma'am.
Okay.
It's intended to be designed so they can do up to 1% for this offsite construction, but anything they do within that 1% credit facility equally reduces their overall authority under the 12.5.
Just to carve out up to 1%.
So this is for manufactured housing?
It is limited to,
Offsite constructed housing units that equal manufactured housing.
it could be manufactured, it could be modular. If you're thinking manufactured in the mobile home context, it could be that, but it could also be offsite.
Right.
Yes, sir. It could also be modular offsite. Yes, sir.
And so as of last November 15th, do you have an idea of what the fund was? So do we have an idea of what this is creating, what 12.5% is creating?
I would defer that question to the treasurer's office as far as how much they have the authority to create currently and what they think this would create an additional.
The joint visits might have that also.
That's
Yeah,
right.
so we'll wait to hear from Ken on that. Thank you.
Okay, so the three here on lines 15, 16, and 17 are saying that any financial loss due to this credit facility is going to be covered by this Vermont Housing Special Fund. What is the Vermont Housing Special Fund? So we're going to scroll past page 4. There's a few just technical, statutory cleanup language there on sub C. We're going to get to this new subdivision E on the top of page 5.
And before you do that, the section D, line 14, previous page, should there, this is the general and housing bill, should they be part of the recipients of the reports?
So the D it's a report on just the credit facility in subsection C, which is separate from the 10% credit facility that currently exists. Under sub C, the treasurer has the authority to create another credit facility of 2.5%. And this is only for financing climate infrastructure and resilience projects there on lines 10 and 11. So technically that report that's required in D is only related to those climate infrastructure and resilience projects. Yes, sir. So when you get to page 5, so what was this Vermont Housing Special Fund that is mentioned above? This subsection E would authorize the treasurer's office to keep the interest on all of the loans that they issue through the credit facilities that are created under this section. So the current 10%, the current 2.5% I just mentioned for those climate resilience projects. If you bump it up to 12.5, you add this new 1% facility. All of that packaged together, all of the loans that they're issuing out, the interest that they receive on those loans back, you would be authorizing that interest and to put that interest into this new Vermont Housing Special Fund. Currently, that interest goes into the general fund. This Vermont Housing Special Fund here, most of the language in this section is just kind of the standard language creating the special fund itself. The fund consists of, monies that you may appropriate, monies transferred from other outside parties, and interest paid on the loans authorized in section 10. That's the key piece, then capturing that interest.
Don't get too attached.
The proposal from the Ways and Means Committee is to take it out. So, and then in C1, what are they going to do with this special fund money? It says here that it is intended to be used, looks at lines 17 through 21, to promote the increased availability of housing, including bulk purchasing of offsite constructed housing. And the capital may be provided on terms acceptable to the treasurer, including in the form of grants, interest-free loans, and an investment in equity stakes of housing projects. So the interest would be solely focused on housing, but given a little more flexibility than that 1% credit facility that was done above. Page 6, the treasurer can use the funds to pay administrative costs, and then, the interest from the fund stays in the fund, kind of moving forward year over year. So that's that piece. The next section, section 4, is for the Agency of Commerce and Community Development in collaboration with BGS to develop a pilot demonstration project study exploring the possibility of reducing housing development costs through modular construction. This is a pilot project that ACCD would work with certain municipalities who are willing to do this project. If you start looking on page 7, it's intended to try to utilize bulk purchasing of offsite constructed housing to then find a developer in a municipality willing to participate to determine whether or not it's feasible to do kind of bulk purchasing of these modular constructed homes to put them in, if that's going to help reduce costs, et cetera. And so this is a pilot project that they would have to administer, working with municipalities. That's the sub D there on lines 12, occurring in one or more municipalities willing to participate. Municipal planning grants can be available for municipalities wanting to participate. And then the sub F is a report back in 2028, written report with recommendations for legislative action based on the success of the pilot and whether or not the report should, whether or not the legislature should enact a statewide building code or codes for offsite construction. Page 8, the next section are some changes to the VHIP program, which I know you all are familiar with. The change here in the subdivision 2, as we discussed actually last year, and Rep. Stevens, I think you brought this up when we were talking about the changes to VHIP. The money is not paid up front. And so this section would authorize the departments through the partnership organizations and how they distribute money to be able to provide those funds upfront at the onset of a project as opposed to at different stages after the project begins. Section 6 is related to the Vermont Economic Development Authority. And what this amendment will do on page 9, or are we on 10? It's going to be on 10. It amends the definition of facility or project. So this would authorize the Vermont Economic Development Authority here on page 10, this new subdivision U, after VITA consults with VHFA, and if they've been requested by a financing lender to jointly finance with the financing lender, VITA can help fund multi-unit, on lines 10, multi-unit housing developments of 5 or more units. However, the authority cannot finance projects that are utilizing funds from the Vermont Housing Finance Agency. So if VHFA is providing money, VITA cannot provide money. But deferring to VHFA, VITA can fund housing if they've been requested to do so by a financing lender. Page 7, we get into municipal plans. So this would amend the municipal plan housing element, the housing element of a municipal plan, I should say. So there on lines 19, the municipality shall include within the housing element an identification and analysis of existing and projected housing needs for the projected population of the jurisdiction, including housing needs for individuals with disability, and provide regulations that allow for the rehabilitation, improvement, and development of the number of housing units needed as identified in the land use plan or future land use map. So expanding upon what they must provide, information on how they're going to meet their housing targets. If the municipality, this is in the sub 2, if the municipality cannot meet those housing targets that are identified in the statewide housing needs assessment, the municipality must provide to DHCD an analysis of what are the regulations and physical constraints that are preventing the municipality from developing sufficient housing to meet those targets. And then the remainder of this section is including a lot of detail about what the municipality would have to provide to DHCD about what are the constraints, regulatory fiscal constraints that are preventing you from being able to meet your housing targets. So they would have to go through and quantify your projected housing need types by including the location, age, and condition and occupancy required. A lot of those details, the needs committee is recommending to strike some of them because they're pretty detailed, and there was testimony that they would be pretty onerous on the municipality. So some of this language in the A and B here, this detail is proposed to be struck. But essentially, the section here is saying municipality in your housing element, tell us how you're going to meet your housing targets. If you're not going to meet your housing targets in the statewide housing needs assessment, you need to provide information to DHCD about what the regulatory physical constraints are preventing you from doing so. And then we get to page 12. And there are two new positions that are being created within the Department of Housing and Community Development. And then you have the effective date of July 1 of 2026. So then I will quickly switch over and take a look at the Ways and Means recommended amendment to that report. There are 4 instances of amendments, and the first, second, and third instance of amendment go together. So what Ways and Means is proposing to do is strike the interest from the credit facilities, strike the ability of the treasurer's office to keep that interest. So the interest would continue to go into the general fund at that point.
Which is about $3.1 million of general fund that we'd be giving up if it stayed there. I think that's the number. We'll get the right number from Ted.
And then it strikes the special fund that goes with it. If you remember, they were keeping the interest, they were putting the interest in the special fund. So if you're taking away their ability to keep the interest, it strikes the special fund as well. And then the fourth instance of amendment here is a rewrite to that municipal plan that we were just talking about. And it makes 2 primary changes. The language in the report that came out of the House General Committee said that the housing element of the municipal plan should identify the regulations that the municipality is going to implement in order to meet their housing targets. And there was some concern about whether that was appropriate to put in the housing element or not. And so that was removed. And then, as I mentioned, there was, you can see here on page 2, the sub A and B removed a lot of the really granular detail that was required to be provided if the municipality couldn't meet the housing targets. You remember it said like the location and the age of the housing, et cetera. They removed a lot of that extra layer of detail from the requirement if they submit information to Department of Housing and Community Development. So that is the amendment.
And if you want to stay there, we'll get Ted up.
I have a few minutes. Yes, ma'am.
You have to go?
If I can leave within the next 5 or so, I have to go to Senate Economic Development
Oh,
for the remainder.
no. We'll try to be efficient.
Take your time.
Dallas. Okay.
Okay. Ted Barnett, Joint Fiscal Office. I am hopping into the Zoom as I speak. So I think I spent a lot of time thinking about how to explain the money mechanics because it requires holding a few separate things in your head to understand why there's foregone interest revenue.
You have a quick question, Lynn, before?
Yeah, before Cameron leaves.
Yeah.
Talk about the 2 positions. In section 8, was there testimony from ACCD asking that they needed these positions or?
And you know, we've got somebody from the committee, so maybe we can have him talk about that. Rep. Charlton can do that.
Okay.
Okay, thanks. Hold that up.
It's Ways and Means, sweet. Okay. So, starting with the state's average cash balance, the treasurer invests that cash through short-term instruments, right, that generate interest. And as far as I understand, that the return on those investments is about 3.5%. The 10% for Vermont program allows the treasurer to, instead of take a portion of the average cash balance and make loans to various projects, economic development. Recently, it's been a lot of housing projects. The return on those investments are lower than what the treasurer can earn through short-term investments on cash. As far as I understand, the interest rate on those investments, what they're receiving back from loans that they've given out, on average is about 1.5%. The range is 0.5% to 2.5%, depending on the loan terms or amortization period on those investments. So that's the piece when you're thinking about expanding or contracting the 10% for Vermont program.
It reduces some interest.
It reduces the amount that the treasurer is investing on cash in short-term investments at 3.5%. And I have no idea, I'm not going to put this full screen why I'm having trouble in this moment, but
It's all fixed.
so that's the general framing. So by increasing the current 10.5 or 10% for Vermont program to 12.5%. That makes approximately $30 million available through the cap that they can lend out. This is basing an estimate on the average cash balance ranging somewhere in the neighborhood of $1.2 billion to $1.5 billion. That's through the end of fiscal year 27. And so by taking that $30 million out of the pool that can be invested in cash, you would be foregoing up to $600,000 in annual interest income. Now, I said the number 600,000. It will take time for, it would take time for the treasurer to make, once they have that money that they know they can expand the cap, they have to, they can make that money available. Folks apply for that money. They decide who they're awarding to. It takes money to get money out the door, or time to get money out the door. And it takes time for folks who receive rewards to start drawing down loans through those credit facilities. So this $600,000 is a maximum theoretical impact. I think practically it would take a few years for the program to fully boot up. The treasurer is, I will say, as far as I understand, fairly conservative. They're not trying to really operate at the full maximum amount of the cap. And as they're making money available, folks are paying money back in. So it goes, it's kind of a revolving process. And so I think it's very unlikely that you would lose that full $600,000 in any given fiscal year. And it's certainly, the key piece is that in conversation with the treasurer, they wouldn't be able to make loans through the expanded facility in fiscal year 27. So it's not a current year budget question. It's just less money that you're receiving in interest income in future fiscal years.
And over, because that's the peak maximum on revenue, not like worst case scenario.
Yes, and looking into the future, the average cash balance is expected to decrease as more federal funds are spent. It won't go down to pre-pandemic levels, but over time we'll see.
Okay.
So that's in terms of the foregone interest piece. There are 2 positions in the bill. The bill does not include funding for those positions, but folks from the committee may be able to speak better about those positions than I can. And then I do want to note that the bill in the pilot program for offsite housing refers to municipal planning grants. I assume that that's referring to municipal planning grants that are from property transfer tax revenue and deposited in the municipal and regional planning fund. It could increase competition for those funds. So wanted to note that as well.
So there's no funding in here for the positions. Two grants management.
Raise them, but there's no.
I'm seeing your last sentence there, yeah. You see that not to amend it, if we needed to go over this. The funding isn't always there. Okay. So at this point, the only potential cost is future foregone revenue, but not in FY 27.
Not in FY 27.
Thank you. $30 million that you say is available, is that the 10% that we currently have, or is that what's projected for the 12.5?
That is projected from moving from 10% to 12.5%. The LIAC, the Local Investment Advisory Committee, has authorized $120 million for the 10% for Vermont program. And so the 30 million would be, the normal 10%, and then 30 million would be in addition.
How much goes for the 2.5 for the climate and resiliency piece?
The climate and resiliency piece is 2.5%, but it's separate from, so in total, through this bill, you would have the 10% moving to 12.5%, and then the climate 2.5% would be in addition. So the total amount of those
12.5
is
total.
15.
Well, you add the other two, yeah.
Yep.
It comes to 15. So it goes from
Currently 12.5 divided into 2.5 for the climate and 10% for housing.
another 2.5.
To the housing thing. The other one doesn't get changed at all. That's just staying the way it is.
So how much has the treasurer or other entities gone and already tapped into this cash fund that we have, this cash balance?
I would have,
Right now.
they have a report, and I'm sorry, I should have had that information with me, but I can provide it to the committee.
We have somebody from the treasurer's office here. Peter, do you want to introduce yourself and tell us anything you want to say about this?
Yeah, Peter Trombley, Office of the State Treasurer. So to date, we've authorized 120 million in loans, but only about 67 million have actually been drawn on. So the remainder authorized loans are still being held as cash investments and earning a cash interest rate. Some qualifiers, if I might add to the fiscal note. One thing that we've been seeing over the last few years is the interest rate we earn on short-term cash investments going down. It's difficult to predict the future of interest rates, but I think it's safe to say it will be lower in fiscal year 28 when we see this change, if the bill were to pass, than they are now. So the difference between what we earn in LIHAC loans, what we earn in cash investments will likely be smaller than 600.
Right, so the foreground revenue could be will be less, because the difference between what we could invest and what we're lending out at, that's gonna be smaller. Because right now, if we're earning 3.5% and we're lending it out at 1.5%, there's a 2% margin there of potential loss. But if we drop it down, if interest rates go down to 2.5%, then there's only a 1% difference between the two.
The final, if I may, qualifier is that what we don't have hard numbers for are the revenues generated to the state through the creation of the housing that these slides is enabling, or the jobs. This program has created or saved 1,700 units of housing and over 140 permanent jobs, which generates through income tax, payroll tax, sales tax, rent, value, revenue.
Well, and people exiting homelessness, which is also a cost that we're now not funding.
Or
for
people
those people.
purchasing their own individual.
Well, or renting, yeah,
And not
well,
just rentals, it may be.
could be any of that, yeah.
There's indirect revenues generated through the program that we haven't been able to quantify yet. We'd like to.
Cameron, I know, go ahead, and then I want to let Cameron go as soon as
Go
he's
ahead.
able
Yes,
to.
no, I don't, I have a question on the finance.
You're welcome to go. Thank you, Cameron, for coming. You may be excused. Go ahead.
Okay, but my question, I'm concerned about the cash balance. That right now, I think our cash balances are probably pretty hefty because we've received a lot of money in from ARPA grants and all this kind of stuff. And yet we are expending them and we need to expend them by a certain amount of time. So I'm concerned that if we are loaning out, and I understand the concept, if we got this cash balance, we might as well loan some out and let it work. But I am concerned about moving it from 10 to 12 in terms of that cash balance, I presume, is going to be getting smaller over time. And I don't like having my little piggy bank squeezed when we might be needing it for something. I mean, I know it's not a reserve fund, but I'm just concerned about the cash balance being reduced and then therefore our loaning more of it out and obviously waiting for that money to come back in.
It's still only going to be 10%, just be a reduced amount.
Yes, it'll be a smaller amount.
It'll be a smaller amount.
Right, but if we go to 12% that
Oh.
we're loaning out as opposed to
Yeah.
10%, that's my
Right,
concern.
so, Peter, do you have a sense of what the cash balance is right now? I see the revenue forecast is in the fiscal note.
Yeah, right now we average about 1.5 billion per year, but you're quite right, Representative, and we want to be conservative, so we look at two things. One, where do we think cash balances will trend over the coming years? And two, what does our cash look like if we take out reserves and restricted funds? Both of those analyses point us towards 1.2 billion. So for the purposes of this program, we assume the state only has 1.2 billion in cash and loan 10% of that, as opposed to the actual 1.5 that we have. So we're trying to base our portfolio where we think it will land in the long term. If this bill were to pass as is, the state would maintain 85% liquidity, which we feel very comfortable with meeting our day-to-day needs. And if there were to be any sort of window requirements to liquidate assets rapidly, we don't feel that this expansion would create an issue there.
John?
Question for you. So, the average is, as it's noted in the fiscal note here, usually cash balance here, 315. That's the average here. What's the range of fluctuation per year? I know things kind of go up and down. Big money goes out, we're earning more back here. It's just a basic sense of that.
I don't have those numbers off the top of my head. I can get you those numbers. It does fluctuate substantially throughout the year, which is why we look at our average throughout the year when we're sort of setting these rates.
Yeah. Thank you.
So again, for Peter, so if I'm a housing developer and I want to develop a bunch of these houses, I'm gonna come to you for a loan out of the Vermont money. What's the interest rate? How does that work?
Yeah.
Because I guess the goal of this is to be able to achieve, to access money at a lower rate than market rate, because if cash is expensive, then the building is expensive. Is that the theory going on here?
That is the theory. We're trying to sort of correct for areas where the housing market is simply more expensive to build and you can effectively charge in rents to be able to make a project cash flow. So we do loan at rates below what you would see in a typical commercial loan. Those range from 1% to 2.5%. And we base that off of the longer of the term or the amortization schedule for the loan. So if you're taking out a loan with 25-year amortization of 35%, we're taking out a loan with only 5-year amortization, we'll charge you 12%. Another thing to note is that to protect the state against risk, we loan through intermediaries. The largest use is DHFA. Sometimes it's banks, credit unions. They add a small markup to the loan, and in return, they guarantee us repayment of their balance sheets to protect the state against the risk.
So that 1 to 2.5% is on the financial intermediary. Is that right? And then, so what's available to a builder or developer is going to be higher than that, which again, at current rates is still much lower by at least a couple of percentage points than what's on the commercial market now.
That is correct.
So I think Peter, you're down, maybe too late, but come up to the table. I should have asked you a lot of questions ago. I thought there would be one, but clearly we have a lot of interest in this. But now that he's up here, do you have a question for Peter now that we brought him to the table?
Okay, now this is design, this is modular homes. Modular.
Could be.
construction. Bulk of it. The idea is that, from what I understand, bulk sounds like we get it cheaper than if you were doing one house at a time, or one apartment at a time, or one anything at a time. So when you're looking at bulk and you're looking at, let's say you're gonna put in a development of 50 homes in a municipality. Okay, and you've got your infrastructure, everything's there, you're all set to go. What happens for the purchaser, or has this been factored in at all? What happens to the purchaser? Is any kind of problem or difficulty for them under this scheme of things of financing and everything to go and get a mortgage, or to be able to, are they limited to what they can borrow, or what? You know, there's very prescriptive language for the municipality. I'm just wondering, if someone wanted to buy a single family home and move out of an apartment, you know, what kind of restrictions or any would be on that?
I don't think I have the expertise to say sort of how lending institutions look at providing mortgages for something like an offsite constructed home. I think for some, my understanding is that for a lot of modular homes, they essentially function as the same kind of asset as any other stick-built on-site home. But I think that can be different when we're talking about manufactured housing, mobile homes. Yeah. The idea behind this 1% is it really came out of an idea for a pilot program that DHCD had. They've been doing a lot of really great work looking at whether we could facilitate, as you say, a bulk order, which would allow us to essentially purchase a large number of offsite homes over the course of a year or multiple years at a discounted rate, purchasing it all at once. And then there would be some sort of kind of coordinating entity, I think likely DHCD, that would coordinate individual developers to say, well, I want 10 of that order, I want 25 of that order, and then they can get placed around the state and sold either to, if the developer is going to own them to rent, or if they're going to be eventually owned by an individual family. The idea being that our 1% credit facility could allow some cash flow to make the intermediary payments in the time between which the house needs to be purchased from the manufacturer, the factory, and when it's then sold to the developer or final consumer.
So what would happen to the credit facility, this thing? We did it and the pilot's done, or we had a downturn, or whatever comes, is this something is this going to be like a bank, or what is exactly a credit facility?
Mhm. So I think the way the credit facility will most likely work, and some of these details would have to be worked out with DHCD and the construction of the pilot going forward. I think the way it would most likely work is we would be making very short-term loans that is purchasing the homes as they come out of the factory and then turning around and selling them to the developer or the consumer. And in that window of time, maybe a few months, they need a loan in order to make the purchase and make the sale. If the pilot were to not be able to move forward or not work out, that 1% capacity could just be used towards our traditional loan program or kept as cash investments.
That's part of the 12.5%.
It's part of the 12.5. We did not want to go up to 13.5.
And if you lose some of your cash balance, if it decreases between ARPA money going out and some kind of a downturn, a recession, whatever it might be, revenue getting softer, does that mean you can decide to go back to 10%?
We would have still the authority to go up to 12.5. It would be the legislature's decision if they wanted to restrict that authority back down to 10. What we would do in a scenario like that, and we typically see average cash balances trending slowly. There's short-term volatility, but the average trends slowly. What we would do if we ended up in a scenario where it was trending down and we felt like we were at risk of going over our monetary cap, we would freeze lending, allow for repayments to replenish the credit facility to bring the total amount outstanding below 12.5. And then reevaluate from there. So we would simply pause lending and allow repayments to lower our total portfolio.
Which is why you have the advisory council too. I mean, LIAC is sort of the check. It's like the loan committee is what they're doing. And my question would be, and then I see you, Wayne, I'll get you next, is what have you experienced losses at all?
We have to date experienced no losses in our credit facility, and that's we haven't had a loan fail from an intermediary to a developer. But what really protects us from loss is the fact that even if that developer goes under or if that loan fails, the intermediary guarantees us repayment. They absorb that risk, not the state.
Right. So it's pretty minimal risk for us. That's what I wanted to get clear for everybody.
We've been running a ton of money for housing through VHCB. I'm just curious as why this mechanism all of a sudden is being proposed rather than something going through VHCB or things that going on here, or
We'd have to give them the money to do it.
right, but we are giving them the money to do it this way only is.
No, I would just say that the money that, especially when now we're really limited to property transfer tax, the question I was gonna have, Peter, is related a little bit. Money we give to the HCB is through the property transfer tax primarily. Then we can make additional monies that are handled differently. And so Peter, the question that I had was, or clarification, is that when we do have money given to VHCB and that money is being used for housing, not all of it is housing, there's a perpetual affordability covenant that's put on that money because it's been raised through tax dollars. And whether it's our tax dollars or the federal tax dollars, whereas this is a loan and it's not restricted to nonprofit housing agencies, anyone in the commercial world in particular. I mean, the difference being nonprofit and commercial, they can apply for these loans through VHFA to build kind of housing. So that even though they're getting the money at a lower rate, is there a perpetual affordability? Is there any kind of affordability covenant on that money, on that building? Or is it just, this is what we're trying to do to spark that piece of the economy or that piece of the segment? It's different money being handled differently. Is that accurate?
Yeah, if I may address Representative LaRoche's question and then yours in order. This is an extension of the Treasurer's Office's historic function around managing the state's cash on hand. The reason, we facilitate these investments, the legislature has allowed us to facilitate these investments is to Representative Dickinson's comments. We're watching the state's cash balances. We're watching the health of the portfolio, and we're dialing it up and down as we need to based on where the state's cash is functioning. So the legislature over a decade ago decided to give the Treasurer's Office the authority to take some of the state's cash on hand and put it into more long-term investments as opposed to short-term investments. It was not specific to housing until Treasurer Pichek came into office and the LIAC committee drafted a new investment policy, because we have a policy that binds our investments, and I can share that if you'd like to see it. And that investment policy contemplated housing as what we felt at the time was the state's most critical need. To Representative Stevens' question, the majority of the housing units we have supported have been either capital A affordable or, affordable in sort of the workforce housing range, anywhere from 60 to 120% of area median income. There have been some market rate units in our portfolio, sometimes market rate projects, more often projects that are mixed affordable and market rate. The reasoning behind that, there is a very critical need in affordable housing, but we also often hear about missing middle, an area of housing where the market, the private market, can't build housing for the cost that they can then rent it out affordably, even to in a market rate unit. There's a market failure there that we're trying to correct for. Or sell. Absolutely. So we have tried to be flexible in this portfolio in providing some resources towards market rate housing. We think a healthy housing market needs everything from affordable to market rate. And quite often there aren't, the legislature generally makes the wise decision to focus its public resources on affordable, which sometimes leaves a gap in resources for critical market rate housing. So we do have some of that in our portfolio.
So those houses that are built through nonprofit housing agencies that receive monies from, as you, somebody said, stack to stack earlier, that project still has to retain their perpetual affordability. But again, I just want to be clear that this is available for any developer who otherwise qualifies, which is I think that's the spark we're trying to give. You call it a market correction or what have you, but just that idea of lowering the cost of money, which is the first expensive piece in development.
Yeah, you're absolutely right. We try not to create a great many restrictions on our program. Every restriction you apply to funding adds time for the project to accommodate perhaps legal fees, design fees, et cetera. We try not to do that. We try to make our money as smooth as possible. We're often lending, we're very rarely the only source of public subsidy in a project. So there's often other forms of public subsidy that, to your point, come with affordability covenants. Oftentimes we lend through BHFA, and they're very avid in making sure that they're looking after the affordability of the units that they're then lending towards. So sometimes it depends on the character of the intermediary, whether they're bringing their own resources to bear. In the case of VHFA, those resources tend to come with affordability requirements. Sometimes we're loaning through a local bank or credit union, and their resources are commercial and at market rate and don't come with those kinds of restrictions.
So is the treasurer's office merely going to be the banker, or is there any policy decisions that go with program?
We're merely the lender. There's an investment policy that is crafted with the local investment advisory committee that is made up of VITA, VHFA, the bond bank, Efficiency Vermont, VSAC, and the treasurer. So there are investment policy choices that are made through that committee in terms of what kind of investments we're going to make, but we're simply lending to an intermediary that's lending to a project.
So all the policies within the realm of investment.
Yes.
Not in terms of what projects get done or even about how those projects get done.
No, we're simply providing another source of capital.
And did you have a question?
Yeah, I was going to say that my understanding is that what the HCB does is, and other housing authorities, nonprofits, what they do is they use, you can correct me if I'm wrong, but they use the federal low-income tax credits that banks, insurance companies, private equity, very, very, very wealthy individuals use to pay down their taxes. You know, they buy $1 million worth of tax credits, and that's the thing that's leveraged into the stuff that the HCB does to create the nonprofits for the affordability.
Tax credits are a big part
There
of
are
it.
15, it's like they're the owners or co-owners or whatever, how it works. And this would not be looking at that piece of the stack that they're so. But the other question I did have, I'll think of it.
Okay. Other questions for folks? Representative Charlton, do you want to introduce yourself and tell us a little bit more from how you and maybe trade seats with Peter here? Thanks for being here, Peter.
All right, thank you.
Don't go away.
For the record, Representative Tom Charlton, House General and Housing. This is the first time I've appeared before the legendary Appropriations Committee.
I like respond.
It's an honor.
Welcome.
Thank you. 775 initially was conceived as a simpler alternative to CHIP, for smaller communities with less capacity, smaller developments in the hands of smaller developers. It's probably not limited to that. Most of our rural communities don't have the capacity without a lot of help to work with CHIP, although it's a fantastic program. This bill has been a very collaborative effort between Treasurer's Office, DHCD, and the Governor's Office. The credit facility on a part of the Treasurer's Office, and you may need to refine how I describe this in layman's terms, is an essential piece. That can be used for infrastructure, it can be used for roads, it can be used for the housing, it can be used for a number of different things that are essential to bring the housing into existence. It dovetails with the offsite manufactured housing accelerator pilot program. Probably the title's longer than that. The way what we're trying to address here is that there are essentially four different kinds of housing that are being built. One is what we formerly called mobile homes, and there are programs for mobile home infill projects and programs. Mobile homes depreciate over time unless they get some extraordinary maintenance, but they are a very cost-effective entry level, get somebody under a roof alternative. There is a beefier version of the same thing called cross mod that's built a higher code and looks more like a conventional home. And these were created so that the mortgages could be traded, could be sold on a secondary market, which you cannot do with what we know as mobile home or manufactured homes. The offsite manufactured housing is the volumetric or panelized sort of stuff that Huntington Homes. It's almost identical to stick built. They just build the sections offsite. And there are a number of benefits to that, which I can explain later because it's a nerdy builder, hammer and nail stuff. This cost savings in the volumetric homes is in building the same model in bulk. Currently, a lot of the customized homes are done this way, and they're as expensive as stick built. But if they are told, and the manufacturers have told us, if we tool up to build the same home 30 times, that's where the cost savings is, because we're not retooling every time we build a unit. We're not redoing the blueprints every time we do a unit. So the combination here to make all of this accessible to small communities, small developers, comes in making the money a little more accessible for the initial building phase. For the offsite pilot, the credit backing of the state is essential in that we're looking to offer, say, a block of 30 homes, whatever the magic number will vary depending on the model and the manufacturer, but whatever that magic number is, we'll say it's 30, they might need 2 in Poultney and 5 in Calais and 3 in Vernon, or who knows where, the smaller developments, smaller communities. We're looking to aggregate those orders into a single bulk purchase to back the order with the credit of the treasurer's office so that the manufacturer is confident to go ahead and build 30 of these things. On delivery, they are bought by the developer. So essentially, they are not at any point owned by the state. The state is providing the backing for, at a lower interest, for these things to be produced and delivered. That makes it less expensive for the developer. And it makes it less expensive using DHCD's 802 homes catalog, where the engineering has been done, the architecture has been done, the designs have all been done. Each of these is a little reduction, little reduction, little reduction in the eventual cost of producing these homes. The nonprofit housing agencies often will come in at to help the purchaser, the end purchaser, which is not necessarily the state, and in this program, not intended to be the state. Other programs that are financed might be, but the idea here is that DHCD might say, yes, we're going to do, and it might be part of the developer's funding stack that they know DHCD is going to do a limited equity arrangement for permanent affordability, or VHFA is going to provide first-time home buyer loans for this project. I think that's the nutshell. I don't want to use a lot of your time, but certainly.
Yeah, and we do need to wrap up. Go ahead.
So say we're gonna build a bulk lot of 30. The money that we're looking for is the money to construct those homes in total up front. Is that what we're doing here?
With the credit facility from the treasurer's office, I imagine there would be there would be an upfront.
So the intent is to pay for the whole buildings upfront.
We're not buying the buildings. We're backing the loan. So,
Back in what loan? The loan?
well, it would essentially be a construction loan for the offsite portion.
Anytime you buy,
I understand. So I'm just trying to get it all straight. So I'm buying a house.
You're buying a house.
I get a loan.
Right.
House has to be built. The money that I'm getting for the loan doesn't go to the builder up front to build a home like it normally would.
Yeah.
We're gonna put the money in up front to build the home, and then it's gonna be back paid from the loan that I get from the bank. That's my money to pay off. Pay for it.
If you're the purchaser, not the builder. So in the I think, and let me try to explain, tell the tale as was told me, okay? The fund that the treasurer is investing, that's made available to the intermediary lenders. Those intermediary lenders are also responsible for vetting the developer at the other end and so on and so forth. Once with the state's backing, because a manufacturer is going to know, hey, you go to them and say, we want 30 homes of the same thing, and they're going all over the state. They want to know before they spend a penny that this is secure. So what the state is providing is the security to the manufacturer, and so already having vetted the developers that are purchasing 2, 3, 5 units.
So a lot of 30 is ordered. And the finance companies, whatever, that are going to manage the loans to the individuals buying it. If something happens that they don't sell enough homes or still don't get the money, then the money that we're putting up is going to back that.
The intermediaries back it.
And so who's the
So,
intermediary? Let's.
Credit unions.
Right, financial institutions.
Very financial
So if you're buying it, you want to buy a modular home.
I go
You
through-
won't notice any of this.
This is all.
You'll just go to the bank and you'll buy it from the developer who's developing the property. You will have no idea what they did to get the money to build the property.
So where does the backing come in? Because of course, the credit union, they're usually, they're the ones on the hook for.
But that's, are you talking about your personal loan to buy the house or the developer's loan to buy the house? Because the developers always have to borrow money to build it because they don't have enough cash, right? So they go to a bank to do it. So the credit union or, the National Bank of Middlebury or whoever the developer is, M&T Bank, the built bank will make the loan to the developer, which they normally
I
do.
understand, yeah.
But they're getting some of the financing. But, yeah, why don't you come back? Not done yet.
Because the pillar is essentially the developer reselling it, he's building something.
But he'd be doing that
And
anyway.
everybody along the line has
Doing it at a low rate,
everybody along the line has to borrow the money before they start getting.
which is what they would be doing anyway.
It's
how it
it's
Trying
the
to
end
figure out-
person isn't the person, it's the beginning person who borrows the money that's backed by, and they have to probably go and get other money, stack it, and then they sell it to a developer who then will.
But it will help the developer, the home manufacturer, so Huntington Homes or whoever,
get.
they'll be more willing to they can do it more efficiently and at less cost if they're doing 30 homes, even if they go all over the state, it's not 30 individual loans and everything they have to keep track of. It's aggregated into one loan to one developer who then they deal with it across the state.
I understand, but what I'm
They save
getting down to is obviously we're doing this because there's a perception, there's a risk someplace.
Yeah, who has the risk is what you're asking.
We're gonna be on the hook to cover the risk. I'm just looking for the pinch point. At what point in time we're on the hook to cover the risk?
Okay.
I want to first, with Peter Trombley, Office of State Treasurer. I want to first caveat this with the fine details of the program will need to be worked out in implementation with the Department of Housing and Community Development and other stakeholders. There are a number of stakeholders listed in the text of the bill. I can't recall them all, but perhaps my friend Representative Carlton can. The state, our view of this is that our money will be what is made available if necessary for the short-term lending needed to purchase a home and then turn around and sell it by the intermediary. Who might that intermediary be? I think that is yet to be worked out. As to when the state is accepting the risk, however we construct this program, our office would be looking to find whatever way possible to receive a guarantee of repayment anytime we make a loan. That has been our standard practice throughout this program. I would say, I think one of the reasonings behind having the interest retention language in the original draft of the bill is that if we had that interest retained, we could use it to cover losses, and therefore our office would be willing to take a slightly greater degree of risk than I think we will be willing to take without the interest retention in order to protect the state's cash balances. So the fine details of the program would have to be worked out, but the idea is that it would, from our perspective, function quite similar to our current loan program, where we're loaning money to an intermediary. That intermediary is assuming the risk, and in return, they get to add a spread to the loan.
Okay,
I understand.
all right. Lynn.
Okay, I remember what I wanted to ask. In section at the end. 7. This is the prescriptive descriptions of what communities, they have to give you all kinds of information, they have to go and do all kinds of things, they, determine what their housing, I mean, it's very prescriptive. This is the kind of stuff that adds to the cost of a house or a building of any kind.
Section 7.
Yes.
This is on the municipality, not the builder.
Yes.
So
But look at the house ways and means one.
Amendment, yeah.
the amendment simplifies that
Different.
list
That
considerably.
does, yeah, because that's part of
And that's
the, and I think,
Mhm.
I don't know if you said it, Peter, or somebody said it, maybe it was the JFO. But the more stuff you add to it,
Oh, yeah.
it's like the everything bagel. Sounds great. We want all this stuff. we're gonna do this, we're gonna do that, we're gonna add that, this is good, we'll add that. And it adds to the cost. I mean, the whole point of this, from what I gather, is to keep the cost down. Everybody's gonna have savings, whether it's the Huntington Homes, and then it's the developer, and then and the state is going, I mean, I don't think that there's gonna be any lack of interest in buying anything or being involved in any of these things, because we have no housing, especially market rate, missing middle type housing. This is something that should address that everywhere. So the question is that if we keep making restrictive, you gotta do this, municipalities may find this, especially smaller ones, may find this difficult. Large ones that can do TIFs and other things, they have the manpower for this. But smaller towns
I'll be
don't.
working with regional planning and they get planning grants, right?
Yes. And
And they'll work with municipal regional planning. There's actually, all of the regional planning folks are now doing a sort of their assessment
Assessments. they
all
have to.
across the
yeah,
state.
so we have that information, many of it. The question is, will a 3-man select board? We went through this with COVID. How is somebody going to take advantage of these wonderful grants that they could get? And we had to go and we did something with hiring navigators or something. But the point of it is we want to have these towns agree to this and participate in it. So that's my goal here. Tell me about how that got discussed.
So first of all, this is not a requisite for the offsite construction.
No,
So
this
they
is where we
already-
get to the,
We've already essentially assigned housing targets to every community in the state. And they're already trying to figure out how on earth they're supposed to meet the numbers that they've been given. This provides them essentially a gracious off-ramp. If they're looking and saying, we've been told we need to build 1,200 units in all of our buildable lands in a floodplain. This provides them the means of saying, we don't think we can meet this target because, or we're 20 miles from anywhere. Who's going to buy 1,200 homes? Any number of reasons. This gives them the chance to kind of articulate the obstacles they may have to meeting those goals that have already been assigned and they're already
To the
trying to work
to the
on. So
municipality.
it gives the municipality the ability to say, here's why we're not convinced that we can make this goal. So and they've already been assigned the task of coming up with a plan for how they're going to meet the goal, but a lot of them are encountering, really significant obstacles, but that we need to know about. So this simply gives them a chance to return that information.
We've gone way over time here, and I have one more question though, because it doesn't count as the money, and that's that you put in 2 positions. You must have heard from DHCD.
We
You
heard,
didn't put in any money.
okay, no, we did not. I think it was pending availability, and that was how we were asked to
Okay.
put that in. And it's
And did DHCD say they needed 2 positions to?
DHCD did indicate they needed 2 positions, particularly in the grant specialist kind of category, just to manage the volume of grant funding, municipal grant funding, all kinds of grants that
They already do that now.
Well, they do it now, yes, and it's
Why do they need more people if they're already doing it.
it's quite a popular program apparently. So
But these 2 positions are not related to the credit facility idea, are they?
not to the credit facility.
These-
To some degree, municipal grants have been made available to the small towns that are trying to step through the process. So that could fall into DHCD.
I would think regional planning would be doing that, not DHCD. DHCD doesn't do that. The municipal RPCs do that. Yeah, I think that's just right.
I think testimony from Alex would probably give
We
you
can
more.
get, people want people. Okay. All right. I think we have our questions answered for now. We're not going to vote on this right this moment. We will vote on it before next Friday or by next Friday because we have everything done then. Thank you both for your time, for coming down.
Thank you.
And I guess it's going to be yours.
no, I think it's the treasurer's office.
Oh, the treasurer's office. It's yours. Yeah. It's housing and the treasurer, but it'll be your bill, but. Okay.
Oh, yes.
Yes, all right. Thank you very much. We're not going to break behind and the next one's really short. Okay, so, we got coming up for this one, Chris Root. Come join us at the table. We don't need ledge council for this. This is not.
You want me to share my screen, Madam Chair?
Or why don't you share your screen? 519, which just came into our possession about 45 minutes ago. So we actually can vote on it. Did we put that we said we might vote on this? Okay, this is a really, I think this is going to be a pretty uncomplicated one, and I'd like to just vote, get it out of here if people are willing to do that after you hear. And if not, we won't do that, but I think it's easy.
Well, good morning, everyone. I'm Chris Root from the Joint Fiscal Office. It'll probably take me longer to pull up the fiscal note than it will take to talk about the fiscal note. The bill before you is a fairly simple one, and so is the fiscal note. But I wanted to, before I started explaining what this is, I wanted to tell you that the title of the bill no longer describes what the bill actually does. So I just want to flag that. So don't pay attention to the title, pay attention to what I'm going to say, and pay attention to what's in the strike all amendment. So you all will remember when Act 114 was created, it was enacted in 2022. A part of that bill included the creation of a new group in the state employee retirement system called Group G. And Group G was crafted to provide for a 20-year retirement plan for corrections workers to allow them to retire at age 55 if they had at least 20 years of service. The incremental cost of the Group G benefit is borne by the employee in Group G, who pays a higher contribution rate of 4.68% more than they would have paid if they stayed in Group F. So Group G was intentionally designed to be cost neutral to the employer, and the employees in that group bear the higher cost of that enhanced benefit in Group G. After you passed that and opened it up for the corrections officers, another bill passed recently that allowed for deputy sheriffs to transfer from Group F into Group G. There were some sheriff's offices that participated in the state employee retirement system, and they pay the cost of their participation. The state doesn't pay that cost to the state budget. They pay their way. But there were some concerns around inequities by having a few deputy sheriff's offices in Group F, whereas state employee or state troopers and a lot of other municipal law enforcement were in groups that had a better multiplier and the ability to retire with 20 years. So you then passed a bill that allowed that roughly 100 or so deputy sheriffs to move into Group G and then have a more comparable benefit that the municipal law enforcement in VMERS Group D and the state troopers in VSERS Group C have. This bill sort of picks up on that theme and deals with sort of one last vestige of law enforcement that for historic reasons was in Group F. And that has to do with, there are 3 municipalities that participate in Group F: Randolph, Bethel, and Danville. Randolph is the only one that currently has law enforcement officers, and I believe there's 3 of them. And what this bill would do is allow those officers to transition to Group G, very similarly to how you allowed the deputy sheriffs to transition to Group G a few years ago, and the corrections officers to do that after Act 114. So this would only apply to municipal law enforcement that are employed by towns that are already in the state system in Group F, and just allows those law enforcement officers to transfer into Group G. So the towns they pay the cost of participating in VSERS, the state doesn't. And these law enforcement officers would be paying for the higher cost of transitioning into Group G. So this is cost neutral to the state and it really, the cost of the participation is borne by this handful of people who are in these town law enforcement. So we looked at this, the treasurer's office has looked at this. We think the impact of this would be, well within the realm of de minimis to the state employee retirement system and would have no cost to the state budget. I did just want to flag, though, that I probably wouldn't say the same thing if there were other proposals that drastically expand the membership of Group G beyond what it currently is. There are some other bills in the building that propose really significantly expanding Group G's membership. Whenever you start really adding on, and especially adding new employee demographics in that might look very different than the people who are already in Group G, that's the point where I think you want the actuaries to go back and rerun the numbers and see if 4.68% is still like the right contribution rate. But this is 3 people that are very demographically similar to the people who are already in Group G. So I feel fairly confident that this is going to have a de minimis impact, and it's not going to have any impact to the ADAC that you all have to fund every year through the state budget. So there's a lot of verbiage in here that just explains the ins and outs of the different retirement groups, but I already sort of went through this verbally. And I'm happy to answer any questions you may have that I didn't cover at this point.
Anybody have any questions? I guess I do because of your cautionary comment. Is the concern that if all police officers, are most police officers in this group already?
There are very few police officers in Group G. Most of them are actually in the municipal system and Group D there.
Okay.
But since we already have a lot of deputy sheriffs in this group and we're dealing with
Okay.
3 FTEs,
Yeah.
my bigger concern is there's a proposal, for example, elsewhere in the building to add all classified employees of the Department of Children and Families into Group G. That would more than double the size of Group G and very significantly change the demographics of who's in Group
And
G.
not the point. Okay.
So when you're dealing with a few people that are sort of similar to the people who are already there, I feel a lot more comfortable.
Yeah. Okay. Great. Everybody clear on what this is? Are people comfortable voting? Dave, are you comfortable voting? He's all right. You're on mute, Dave, but
Yes, I am
Okay.
comfortable.
okay, thank you. Looks like everybody is. Is there a motion to approve H 519 as amended? Okay, it's a strike all, so I assume it's as amended.
Yep.
Okay. Second? Wait. And I'm not seeing further discussion at this point, so if the clerk is ready.
Representative Bloomley, Representative Dickinson,
Yes.
Representative Feltus,
Yes.
Representative Kaczynski,
Yes.
Representative Roche,
Yes.
Representative Rowicki,
Yes.
Representative Nigro,
Yes.
Representative Squirrel, yes, Representative Stevens.
Yes.
Representative Yakavoni,
Yes,
and Representative Shea.
Yes,
11-0.
great, thank you. And this is pension, so Lynn, I think this must be yours also. It's your day. Everybody's getting a day, and today is Lynn's day. Okay, thank you. I have a question on this 775, just to go back to that for a minute. You don't have to answer it right now, but I'm thinking that we might like this bill if I requested an amendment removing the 2 positions. I'm not comfortable myself with those 2 positions. The rest of the bill, I'm fine with moving along. But I would like to remove those, please. Okay, so I will ask for an amendment and then maybe we,
That. There may
just
be-
that, that there's.
Yes. Just on the staff
There may
part.
be another couple things that after I think about it, that I might want to amend as well. But I
Okay.
think certainly.
Okay. Yeah, all right, so we'll request, who is that, Cameron? Can't remember. who it is.
Yes.
Okay, I'll talk to Cameron and then maybe we can have a conversation.
Okay, yeah. about the reviews.
Yeah, so committee, I have a couple of things, no, one thing for now, I'm gonna check on the other. We are getting a new fridge. This fridge died, you may have noticed. Please clean it out before we all get fumigated, So if you have stuff in there, would you check before you leave today and just throw everything out? Because if it's been there for 2 weeks, it's been unrefrigerated.
no,
So take a look.
Right.
The other thing I just want to say is I think we may have more security starting daily, and it may start next Monday, and we would be the test case because we're here, it's like sneeze in with one committee on a Monday. I'll confirm that with Sergeant at Arms, but maybe starting to every day. That's security. All right, I think that's all we have for the morning. Is that right, Autumn? Am I saying the right thing? Okay, so you have time to work on your spreadsheets.
Good.
And we will have a bill at 1 o'clock, and then we may have more chat about 775, how we are with that.